I'm Shae Russell from ABC Bullion, and joining me today is Rick Rule, private investor and speculator. Rick, how are you today?
Delighted to be with you, Shae. Thanks for having me on your new channel.
Yes, I'm very excited that you could be here. Now, we haven't spoken in a couple of months, and there's a lot of ground to cover. But first and foremost, I can't have you on a gold channel and not ask you what your thoughts are on gold. First and foremost, let's go back to August last year when a bit of the heat came out of the gold bull market. And gold has been in a bit of a downtrend until, say, March or April. But the US dollar price of gold has started picking up. Tell me, what are your thoughts on the gold price at this point? Is the bad news for gold over?
I'm not sure it's over, Shae, but the circumstance that we've seen, at first the price malaise and then the price decline, is normal and natural if one studies past gold bull markets. As you know, I've been through two prior markets, the 1970 to 1981 market and the 2000 to 2011 market. And both of those bull markets were punctuated by fairly severe cyclical declines in secular bull markets. So the circumstance that we have been through beginning in last August, as you described, while it may unnerve speculators who haven't been through the circumstance before, is both normal and natural. And at least in the US market, often accompanies, as this one has, a strengthening in nominal and real interest rates. The correlation in the decline in the US gold price with the increase in the interest rate in the US 10-year Treasury from 60 basis points to 175 basis points is uncanny.
Rick, before we move on to US bond yields, I just actually want to talk a little bit about the correlation to how gold stocks have performed with the gold price going down and then back up. So, are we looking at seeing gold stocks bouncing out of this along with the gold price?
I think so. Gold stocks traditionally have amplified the underlying move in gold, which makes perfect sense. An increase in the gold price leads to outsized free cash flow increases because the gold price normally increases faster than the cost do. So one would expect that the gold equities prices would magnify moves in the bullion price, both up and, of course, unfortunately down. And that's the circumstance that we've seen. While the gold price has declined moderately in the last, 8, 9 months, the gold equities, at least certain classes of the gold equities, have magnified that move fairly substantially, which is also, if one studies the last two bull markets, something that one would expect. I expect that the gold price will begin to firm with the moderation in the increase in US interest rates. And I would suspect, as we've seen in the last week, that the gold equities prices will firm with the bullion quotes.
Now, speaking of gold equities, before we get on to what's happening with inflation and US interest rates, let's talk about producers, developers, and explorers. Now, are there any that are rallying a little too hard at the moment, or that are any that could do with some investment interest?
Yeah, I've never seen a bull market where market leadership went immediately from the best of the best, the biggest of the best, all the way down to the penny dreadfuls. I've never seen that before. In my lifetime, in prior bull markets, the 5 or 10 best gold companies in the world moved first. When the institutional money comes in, it goes to the largest and most liquid names. And frankly, speculators who have gone through a bear market are a bit gun shy, and they tend in the beginning to want to be among the best and the most liquid too. And then leadership falls to the best of the rest, the single asset producers, the multi-asset producers with smaller mines, then to the developers, then to the explorers and the juniors. What happened this time was very odd. The first time in my career, the leadership started where one would expect: the Francos, the Newcrests, the Barracks. But then leadership almost immediately went into the sub 250 million market cap space, went to the juniors. I suspect that's because there's a new class of speculator involved and because information is distributed through alternative media such as yours. The younger speculators in particular, I think, are much more narrative oriented than their forebearers were, who were, at least early in a bull market, somewhat more arithmetically oriented. But I've never seen a circumstance where the leadership changed this fast. And I have to say, from my own point of view, with certain exceptions, the junior market is way too frothy for me to participate. As a consequence, I've been cashing more checks than I've been writing in the junior space.
All right, let's touch on what you just mentioned there about how the narrative is driving perhaps young speculators into the market. Let's do a then and now comparison. What has changed from when you started out investing in the mid 70s, I believe, to essentially the young kids getting into the investing market now?
Well, the early part of the decade of the 70s, which is when I actually started, was wonderful because most people couldn't spell gold, despite the fact that it was a four-letter word. And so anybody who cared had the space to themselves. The move in gold from 35 US dollars an ounce to $70 US an ounce, that is to say, a doubling in the price of gold, was unnoticed. And one had one's pick of those few remaining companies who produced gold after a very, very, very long bear market. The consequence of that for those of us who were lucky enough to be in early was spectacular. I remember names like Coeur d'Alene Mines, which went over the course of the decade, from 10 cents to $65. Truly life-changing moves. The decade of the 70s was unusual because we came into the decade with the price of gold controlled. So it was unnecessarily depressed. The consequence of that, of course, is that the gold price went from 35 US dollars an ounce to $850 an ounce over the course of the decade. This circumstance, of course, the price of gold hasn't been controlled. So I think it would be unreasonable to expect a 25-fold increase in the gold price and a concomitant increase in the price of the gold equities. That notwithstanding, Shae, both the duration and the dimension of gold bull markets surprise and shock people who aren't used to them. Many people, including many Australian people, have emailed me and said, so it looks like we've been in this market 3 or 4 years. Did I miss the boat? Is it over? And I need to respond that there's no certainty, but for reasons that you and I can discuss later in this interview, I think we're in the early part of the bull market. And these bull markets, in my experience, have lasted 10 or 11 years, not 2 or 3 or 4 years. The dimension is interesting too. Let's leave aside that first market where the price went from $35 an ounce to $850. Let's look at the 2000 to 2011 market where the gold price went from $250 an ounce to $1,900. Not a 30-fold move or a 20-fold move, but a handsome move indeed. I'm not saying that the gold price will double from here, but there's no reason I can think of why the gold price wouldn't double or triple, or at least couldn't double or triple. And I think that's what many people are missing.
Well, let's delve into the reasons that are driving this bull market this time around and why you don't think it's a short-term one. Now, they're largely to do with rising US deficits, quantitative easing, and negative real rates. So let's expand on how you see these driving the gold price forward.
That's exactly right, Shae. I think when Australian people consider at least the US dollar gold price, what they need to consider is that although many factors around fear move the gold price, the most important fear is the fear of the purchasing power of savings denominated in conventional savings instruments. In the US, the benchmark instrument is the US 10-year Treasury. It's the savings instrument against which all other instruments are valued. And we'll come back to its characteristics versus gold in a moment. But when we say that fear of the purchasing power of savings is what drives the gold price, I think that there are 3 factors that are particularly worth considering, which you described. Quantitative easing, which you have heard me in previous interviews describe as counterfeiting, because that's what it is. The creation of additional currency units, not needed by the economy, but perhaps by the politicians' perception of the market, that are created speciously from thin air. Obviously, this debases the currency. If counterfeiting was a good idea, the Australian government would let you frank Shaes. You could print your own currency, but if you did it, it's an indictable offense and you would be thrown in prison. If an MP does it, it's highly popular and he or she gets reelected. That notwithstanding, it strokes fear of the debasement of the currency. The second is debt and deficits. I don't know the appropriate Australian numbers, but in my country, the numbers are mind-boggling. At the federal level, not state and local, at the federal level, we owe each other $28 trillion. That's 28 with 12 zeros after it. It's an incomprehensible number. And it's small compared to the off-balance sheet liabilities, the net present value of entitlements. If you want to know what an off-balance sheet liability is, Shae, if that concept is difficult for you, look at me. I'm 68. I get Medicare, I get Medicaid, I get Social Security, I get all these wonderful benefits that I voted for myself and forgot to pay for. And the net present value of those obligations is estimated not by some cranky old libertarian, Rick Rule, but rather by the Congressional Budget Office at over $120 trillion. So American federal liabilities at the federal level exceed probably $150 trillion. And we service this debt with a budget that's in deficit $3 trillion a year. It's as though, Shae, you had $150,000 in credit card debt. I'm not casting dispersions on you. And you attempted to service that debt with an income that was $3,000 a year negative. The arithmetic, let's just say, is challenged. And that also gives people cause for concern about the efficacy of their savings. This type of finance traditionally has worked itself out either through a formal default, which is the US government saying to the bondholders, too bad, so sad, we lied, no bond, unlikely, or by inflating away the net present value of the purchasing power of the denominator of the debt, which is what we did in the 1970s, which is very good for gold. But the primary determinant of the gold price is negative real interest rates. So let's revisit our old friend, the US 10-year Treasury, or at least my old friend. The US 10-year Treasury, as I say, is regarded worldwide as the world's benchmark security. The US dollar, for all its faults, is still the world's reserve currency, the largest and deepest, most liquid debt market in the world. The US 10-year Treasury currently yields 1.75%. In a currency where the purchasing power of the currency for 2021 has been estimated by the Congressional Budget Office to decline by 4.2%. Now, this is unusual. The US federal government is actually telling you the truth. They are telling you that if you give them money now, they will give you back less in 10 years. Specifically, they will give you 175 basis points in a currency that's depreciating by 420 basis points a year. My friend Jim Grant, who I think you met at my conference some years ago, describes this value proposition as return-free risk. Think about the concept of return-free risk. So gold, from my point of view, is fighting a war against an instrument that offers return-free risk. And I think that gold can win this fight. When your listeners say, Rick, how will I know when the gold bull market is over? I think you look at the three factors that are causing it. When the politicians in your country and mine stop quantitative easing, which is to say when counterfeiting, federal government counterfeiting ends. When budget deficits recede to the level where economic growth exceeds the percentage increase in the deficit. That is to say, when there is some potential that the economy can service the debt. And when interest rates, real interest rates, revert to mean. By revert to mean, I mean that for the last 30 years, the US interest rate has exceeded the rate of inflation on the 10-year Treasury by between 150 basis points and 200 basis points, pardon me. So reversion to mean, given that the CPI stated rate of inflation is forecasted to 4.2%, means that the yield on the US 10-year Treasury would have to rise from 1.75% to some number closer to 6%. If that 6% interest charge rippled through the US economy, that is to say, if the 30-year fixed mortgage rate increased by that order of magnitude, if the cost to refinance other parts of the government debt increased by that order of magnitude, I suspect that the impact of the US economy would be fairly dramatically negative. And I suspect, too, that if that happened, the voters would ask the politicians, and the politicians would comply with the request to revisit their old friends, which is to say counterfeiting, debt and deficits, and artificially low interest rates, all of which are good for gold. If I'm wrong, and you see positive real yields on the US 10-year Treasury, you will know that it's time to worry about your gold and gold stock holdings.
So you've just outlined a pretty bearish case for the US dollar there. Do you see that gold, I think bearish is being kind, but do you see gold as challenging the validity of the US dollar, or do you see the two working in harmony for investors in the future?
I don't, and we'll talk about the arithmetic behind that in a moment. The U.S. dollar is interesting. My friend Doug Casey refers to the U.S. dollar as the prettiest mare at the slaughterhouse, meaning despite all of its faults, it's better than most of the fiat alternatives, including, in fact, the Australian dollar. If you had a decline in demand for, as an example, iron ore in China, I think Australia would have a religious experience. That isn't to insult your economy. It's just to say that reports of the demise of the US dollar are greatly exaggerated, not because of the strength of the US economy, but rather because of the weakness of the competition. It's a very odd place that we find ourselves. And I don't see gold replacing the US dollar. I just see it losing the war less badly, Shae. Over the last 3 decades, the median market share of precious metals and precious metals related assets relative to all other asset classes of savings and investment in the United States has been between 1.5% and 2%, which is to say that precious metals and precious metals equities have maintained a 1.5% to 2% market share against other asset classes in the United States. The current number is 0.5%. So gold doesn't need to win the war against the US dollar. It just needs to lose it less badly. It needs to revert to mean. And we have a circumstance in the US economy, at least, where the whole country, the voters, are crying, devalue the dollar, devalue the dollar. Understand that a democracy is many things, but one thing it is a forum for a war between spenders and savers. Spenders are numerous, savers are scarce. The spenders are winning this war, the savers are losing this war. And that, sadly, while it's bad for savers, is good for gold.
All right, well, we've nearly run out of time today, but I've got a couple of things I want to go over with you before we go. Now, obviously, we're going to have a few more chats going forward in the months ahead, but also, too, I believe that the Sprott Natural Resource Symposium is going to be online once again this year. Now, we took part last year, and here in Australia, I must say it was fantastic because we got a front row seat to something we normally wouldn't get to attend. So you're going back online this year. Can we expect the same sort of lineup as last year?
Shae, absolutely. We learned a lot about technology last year. Thank God it worked, by the way. We were able to entertain 2,100 people worldwide last year as opposed to our normal 600 or 700 live. And while I miss taking your beautiful self on a boat cruise in Vancouver, with some wine live, it was lovely to be able to do this with no one having to fly. We're going to do it virtually this year. We're going to employ some lessons that we learned last year to make it better yet. I believe that you'll have a link to this conference on your website. And I'd like to make a special promise to people in Australia who would like to attend.
Yes.
If you pay the attendance charge and you think for any reason at all that you haven't got your money's worth, I personally will refund it. Money back guarantee. If you don't think that you got your money's worth, if you don't think that the lineup was as good as I say it is, if you don't think that you got actionable investment advice, if you think for any reason that your investment wasn't worth what I charged you for it, let me know and I'll make it free. Please don't take advantage of that. I've been offering this for 20 years and I've given, I think, 2 refunds in 20 years. But if for any reason you're unsatisfied with the product, you don't pay.
All right, Rick, that's an incredible offer, and I actually find it hard to believe that anybody would be unimpressed with that. I know each year that I've attended, I've often been blown away by the little insights that the speakers drop with, although last year I think my favourite speaker was Robert Friedland, but we're not supposed to have favourites. All right, now just before we wrap up, I know you have a regular offer that you do like to make to people, so let's talk stocks or commodity-related stocks and your views on them.
Absolutely. I'd like to extend an offer to any of your listeners and subscribers. If they care about my opinion of their natural resource stocks, they can find it out. Go to a website, sprottusa.com/rankings. Enter your natural resource stocks in that list. Please, no psychedelic stocks. Please, no technology stocks. Understand my age. I do what I do. I'll rank those stocks 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues where I think my comments might have value. In addition, if you mention charts in the questions and comments section, I will include by return email the Barron's Gold Mining Index, not because I'm a technical analyst, but rather because it's the best visual representation of prior bull markets and the best way to understand the anatomy of the bull market that we're in. And further, I'll send you a 100-year commodity chart showing you just how cheap industrial commodities are relative to other asset classes going back 100 years. There's no reason why I can think of why any Australian wouldn't possess a 100-year commodity chart.
Well, that's a great place to finish, because after all the kerfuffle in commodity prices in the past month, next month, I think we should have a commodity focused chat.
I look forward to it.
All right. Thanks for joining me today, Rick.
Thank you, Shae.